Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance and money management.
All right, folks, welcome back to the Property Couch podcast. G'day, Ben. How are you?
G'day, mate. How you going? You must be up and about. Another win for the Dockers, hey?
I've noticed a strategy of yours. Your attack is the best forward of defence. And it's funny. I was heckling a mate of mine who's a Collingwood supporter, and I put it in the disguise of I sent him a text and said, "Hey, listen, can I just run this past you? I've got to practice for Ben on the podcast this coming week." And it was just a big slapdown of Collingwood, which was a lot of fun. But he was a bit like you, just sort of played a straight bat and didn't play along at home. So that wasn't what I was hoping for. But
look,
are you like, have you got any? Are you just still the best team ever? Just the way the boys are going is pretty good. Like, we're just going to trot out a few platitudes.
No platitudes. It's just I've worked out what it is, though.
You can't play. You're rubbish.
Every time I go, they lose. So I just have to stop going to the game.
Stop going to the game.
I haven't been to a winning game this year.
Yeah. So, well, mate, Fremantle's up and about, and I created the link. Obviously, the coach is no longer at Collingwood, and you've been going down there. I've raised that with you before, but hey, we've got a very special guest today, a returning guest, third time on the podcast. I'm super excited about that. Before we get to our very special guest, I just want to do a little shout out to our community. There was a bunch of people who joined us, Ben, in our Start and Build program, so that they can retire on $2,000 a week. So I'm excited about that new intake of students, and looking forward to seeing what they can achieve within their own portfolios, which is super cool. And another thing, I reached out to Hayley Mitchell and I said, hey, by the way, Hayley Mitchell, of course, was episode a few ago regarding the changes to the legislation in Victoria.
Yep.
And I said, by the way, what does the new legislation changes in terms of residential real estate providers, if that applies to short-term Airbnb?
Just say landlords, mate. Everyone else in Australia knows them as landlords.
Just for this segment, I was being, technical. And I said, does it apply? And she said, no, not that she is aware of. And she's got personal experience in her own portfolio in this space as well. So we'll keep looking. And she didn't definitively say no, but she said, as one of the experts in this space, it's not across her radar at the moment. So that's a couple of questions that we've had. So hopefully that helps out those folks who might have that lingering question also, Ben.
Beautiful.
Hey, Ben, you had a picker webinar this week also.
Yeah. We had Jeremy Shepherd doing some teachings around the data to use to help do your best research. So obviously for Picker members, you've got that on demand. If you just log into the Picker website, you'll be able to get some education around what data matters when you're doing your research. So it's a nice little educational webinar from Jeremy.
All right, go and check that out, folks who are members. On demand, you can check that out. Hey, Ben, my Mindset Minute theme today is obviously wrapping up what's been a very, very entertaining time for me. Hopefully it's added value to the community. I've had some good feedback around it. And it's the book, How to Win Friends and Influence People. Ben, I said at the beginning, if I had to forget everything I knew except for one or two books, this would be one of the books that I said I would not want to forget because it's been phenomenal. And the fact cutting another lap so publicly like I have, it's just really crystallized some of the learnings, and it's been super, super cool. So what I thought I'd do is, despite your heckling last week, I am going to summarize the book. Now, I do not have permission. I have not gone to How to Win Friends and Influence People's publisher and said, can I do this? So I just want to do the announcement here, Ben. I want to encourage each and every one of you to go and buy the book. It is a phenomenal book. It should be in your library. Put it on your audio book list. Go and buy it. I do not want to rob them of any money whatsoever. I think it's that good. I just wanted to share it with our community, but I need to be mindful of it's not my material. So therefore, please just support it if it's added value. Go and buy their book, and so that it recognizes the relevant people. But Ben, in terms of summarizing it, there's a lot, right? And I think the learning is here. So I'm actually going to do it over 2 weeks. I know he said I was going to stretch last week, but this will go forever otherwise. So part one was the fundamental techniques in handling people. Number one, the subject heading was, if you want to gather honey, don't kick over the beehive. And the takeaway was, don't criticize, condemn, or complain. Second chapter, the big secret in dealing with people. And the takeaway was, give honest and sincere appreciation. And chapter number 3, he who can do this has the whole world with him. He who cannot walks a lonely way. And the takeaway was, arouse in the other person an eager want. So that was part 1, fundamental techniques in handling people. Part 2, 6 ways to make people like you. Chapter heading was, do this and you'll be welcome anywhere. Takeaway was, become genuinely interested in other people. Number 2, a simple way to make a good first impression. The takeaway is to smile. Number 3 is, if you don't do this, you are headed for trouble. Takeaway is, remember that a person's name is to that person the sweetest and most important sound in any language. Number 4 was an easy way to become a good conversationalist. Takeaway is, be a good listener, encourage others to talk about themselves. Number 5 was how to interest people. Takeaway was, talk in terms of other people's interests. And number 6, how to make people like you instantly, Ben. Make the other person feel important and do it sincerely. So that's the summaries for the first 2 parts, Ben. As I said, I'll circle around next week to round this out. But again, please go and buy the book or go and buy the audio book. It is well worth the effort. Now, Ben, very exciting guest today. Last week, you were one of the first to see it. Our guest, Tim Lawless, put out a report that was talking about whether or not we have been through the peak rate of growth for this part of the cycle. And we thought it would be amazing content to share with our community. You reached out to him. He agreed to come on. So let's cut to the interview that we recently had with Tim Lawless. All right, Ben, we've got a very special guest today, returning guest. We are chatting with Tim Lawless. He is one of Australia's leading property market analysts and commentators. He was the founder of CoreLogic's Australian research division, formerly known as RP Data. Tim's expertise is sought by governments and regulators, as well as corporations in the property, banking, and financial sectors. As research director, Tim heads up a team of analysts in Australia and New Zealand and reports on property market conditions and the interplay between economic and demographic forces. Tim is a returning guest, having previously shared his insights on the Property Couch back on episode 90 and episode 156. Welcome back to the Property Couch, Tim.
Thanks, Bryce. Great to be on again.
It's great to have you on.
Superstar.
Hey, quick question.
We've got a superstar. Woo!
very, very nice introduction there from you too, Ben. But hey, Tim, your insights are sought by a lot of people, right? So you would have been very busy through the pandemic, and we've obviously had a lot of debrief around the pandemic. But my question for you, the opening one, was: were you surprised how much we bounced back after COVID from a property perspective?
Well, yeah, I think I'm pretty surprised about the speed of the recovery. I think everyone was surprised considering there was so much uncertainty around this time a year ago. But as the market was gradually improving, as the economy improved, I absolutely didn't expect we'd be seeing the strongest growth conditions we've seen since the late 1980s. So yeah, it is out of the blue a little bit. And sure, interest rates are extremely low. We've seen this absolute surge in consumer sentiment, which is really more about the economy improving much faster than forecast, seeing low stock levels. But still, even with all those factors, I absolutely wasn't expecting the speed of this sort of rebound. So yeah, kind of a little bit surprised, but when you look at the factors, maybe it shouldn't be all that surprising.
During COVID, Ben and I were trying to encourage our community to stay calm by using an analogy around the economy and property was a bit like a car where you had the RBA tweaking the engine through interest rates, dropping that down. So it's a fully tuned motor. Then you had state and federal governments at the back of the bowser pumping incentives into the car. And so really all it was missing was a driver. But we probably, in hindsight, missed the fact that the car was redlining. It was revving at 7,000-8,000 revs. And as soon as someone got in, it was going to race off, which is what it's done. But only in hindsight. We thought there would be some strength in it too, but we're surprised by it as well. What's your thoughts on the government's wanting to see the property market do what it's doing? Because it's certainly going to help them with their cause for us to recover as a broader economy quicker.
Well, it was always going to be the case. I think that housing markets responded to so much stimulus as well as very low interest rates. I mean, the RBA themselves were referring to a paper that they'd published a few years earlier by Saunders and Tulip, which noted that for every fall or every 1% drop in the cash rate, there was a commensurate rise in housing values. So I don't think there's any surprise that the housing market has responded to that, maybe not as quickly or as significantly. But I think the government in many ways was really hoping that the housing market would move into a fairly strong recovery phase, which is exactly what it's done. Hoping for the wealth effect to kick in, which again, I think has really gone according to plan. Just look at the retail spending data. It's been very strong. We know that consumption's about 60% of Australia's economic growth. So fueling consumption or spending and I guess disincentivizing savings has been really critical in Australia's bounce back economically. So yeah, I think the RBA is probably fairly comfortable with how the housing market has responded. Again, maybe not so comfortable with the speed of the growth, but we know that the Council of Financial Regulators, being the RBA, APRA, ASIC, and Treasury, will be watching lending quite closely. We all know that any material slippage in lending standards probably will result in a tightening of credit. So that's definitely probably going to be one of the key factors to watch, is whether or not we do see another round of credit intervention, which we know from previous macroprudential episodes back in late 2014 and 2017, tighter credit conditions have a fairly immediate and quite material impact on the amount of housing market activity and the pace of capital gains.
Tim, I want to come back to that story around, macroprudential and what might happen there. But I want to lean into that story around, because this is not your first rodeo, right? So we've been through these economic cycles before. Obviously, you've been around a long time. I'm interested in your thoughts around why it is that government always go household or property when there is potential risk of downside in economic activity. Obviously, we know that's the lever from a monetary policy point of view that the RBA's got. But we're seeing more and more now where, back in Costello's time where, we did first homeowners grants and all these types of things. So my question is, I'm really interested in your view that is property too big to fail?
Well, let's go back to the first part of the question first. So why do governments look towards housing? Well, we know that housing has a significant multiplier effect on the economy. It's not just increasing household wealth, but every time you see a home transacting, a lot of events happen. You see the intuitive stuff, like a real estate agent gets paid. Everyone likes to see that, I'm sure. But you see mortgage brokers, more bank credit flows. You see conveyancing, removalists, building and pest inspections. But probably more important for the economy is you see a lot of retail transactions as well. You see appliances, white goods, home furnishings, renovations material. So that multiplier effect is really important. And then you also start to see generally more development as well. The residential construction sector is a very significant part of the Australian economy as well. And we just need to look at the dwelling approvals data now, which is at a record high for house approvals, which is another, reflection of that. But going back to the other part of your question, why would we generally see governments looking towards housing outside of that multiplier effect? They look for a transmission mechanism for their policies. So they look for that wealth effect where, as consumers or households feel more wealthy, it generally means they're more willing to spend in other areas of the economy. So it's probably that dual mechanism there, where you have a transmission mechanism for monetary policy and fiscal policy, as well as that really broad multiplier effect that the housing market delivers. There's pros and cons to that. For people who don't yet own a home, then you really don't see the benefit of the wealth creation coming through. So, and you see affordability constraints starting to shine through. And we're probably just starting to see the first signs of affordability constraints becoming more impactful on the market. Not necessarily people having challenges paying down their debt. That's pretty straightforward considering interest rates are as low as what they are. The challenge is more around barriers to entry to the marketplace as housing prices rise so much faster than incomes. So affordability constraints in terms of getting your foot in the door are now becoming much more challenging. Whereas once you own that asset, paying down the debt thanks to very low interest rates is generally as practical as it's been since a couple of decades ago.
So just on that point, what about does Treasury and Government look at the risk of LVRs and overall debt? I mean, that's, we only have to go back to the GFC to see what happened in America with obviously, very ordinary lending standards. But we also know the ramifications of a collapsing property market similar to the wealth effect. It actually has a serious economic effect, not just in the property and construction space, but more broadly for the economy, doesn't it?
Yeah, absolutely they do. And if you look at probably the four key metrics that I think the prudential regulator is observing or monitoring very closely now, it would be the proportion of interest-only lending, which is still quite low. It would be the proportion of loans written on either high debt-to-income ratios or high loan-to-income ratios. Anything over 6 times on either of those measures would generally be a bit of a cautionary warning. And also looking at the proportion of high LVR lending. So how many borrowers are actually taking out a home loan with only a small deposit? The December data for each of those measures, which APRA published, did show an uptick in each one of them, although not a material uptick. And APRA described it as a rise, but nothing too far from the long-term averages. So I think when we see the March data being published, and unfortunately there's about a 3-month lag in these data sets coming out of APRA, so we won't see the March data until probably about the middle of June. It probably will show a further uptick in what they describe as those riskier types of loans. Whether or not that'll be a catalyst for a credit tightening regime is yet to be seen. Most of the banking sector believe that it probably won't be until maybe early next year that we could see any sort of credit intervention. But we know from previous rounds of macroprudential, it probably would have a fairly immediate dampening effect on the marketplace if there was a tightening of credit rules.
So let's round that conversation out with, do you have any views on whether we'll see that? I mean, if the rate of growth continues at the levels that we do and we're starting to see these stress tests starting to show some amber and red lights, do you have any sort of, crystal ball view on when we might see some of that intervention?
Well, I don't think it's going to be anything to do with the housing market for starters. Okay, so APRA and RBA are very clear. It's not part of their mandate to control housing prices, but what is part of their mandate is financial stability and prudent lending standards. So I think any sort of intervention from a credit perspective is going to have to be, well, the catalyst is going to have to be a slippage, a further material slippage in lending standards. So whether or not that happens is highly uncertain. I don't think it's just around the corner, but yeah, I'd say increasingly it's becoming a case of if, not when. And if we do see an ongoing decline in the quality of lending, and we do see a lift in those higher LVR loans or higher debt to income loans or high interest only loans, then yeah, I think almost certainly we'll probably see some sort of credit tightening. What would that look like? Probably something like firm limits on how many high LVR loans could be written or high DTI loans could be written. It could be some tightening of the serviceability buffer. At the moment, remember it was back in July of 2019 where that serviceability buffer was changed from a hard limit around a little bit above 7% to a floating rate of 2 or 2.5% above the going mortgage rate product rate. So we could see that tighten just as a reflection that eventually interest rates are going to have to rise back to more normalized levels. So we know New Zealand's already gone down this path, but conditions were very different in New Zealand. They were seeing much more investment than we were here in Australia. Investors have only lifted off record lows through February, but still only about 24% of lending at the moment. So nothing really alarming about the level of speculative activity in Australia's housing market.
In direct comparison to back in 2017 when the investor activity was at sort of record high levels, wasn't it?
Yeah. Well, it was back in 2015. So if you remember, APRA brought in that 10% speed limit on investment credit growth in December 2014. Took about 6 months for banks to implement it, but we saw investment activity move from around nearly 50% of mortgage demand very quickly to a much lower level. So it's not even comparable in terms of investment activity now compared to where it was over that previous very strong growth phase.
You said before it's when, not if, potentially. So that also can be self-fulfilling, doesn't it? As everyone tries to jam in and get in as quickly as they can, which on already low stock levels, and then all of a sudden that sees another uptick, and kind of can be self-fulfilling if people do buy into that narrative, right?
Potentially. I think APRA has a history of operating over the desk, so to speak, rather than overtly through changes in credit policy. So I've got a sneaking suspicion that all the major lenders know that their activity is going to be monitored very closely, and I don't think any lender is going to be wanting to attract the ire of the credit regulator. So I think lending standards are going to hold relatively tight going forward, and probably only quite gradual or progressive rises in some of those indicators I mentioned, which is why we probably won't see any sort of intervention until maybe late this year or coming into early next year.
Tim, last week you and your research team released a paper, almost similar to a discussion paper, really, where you raised the 7 signs of housing markets may be moving through the peak of growth. So I think what we want to do is step through, for our listeners, we want to step through those 7 points and talk to those, because I think we've done a nice little scene setter there where we are talking about some of the macro prudentials and some of the other things. So when we get into some of this insight and data, we should be able to weave that back up into that sort of macro prudential, but also look at the counterbalance around those growth drivers in terms of what's got us to where we are today. And I think there's some more of those growth drivers in there. So do you just want to give us the flavor of the paper, and then we can start to talk about those 7 signs?
Yeah, absolutely. So we have already been seeing some evidence that the housing market may be cooling, but it comes in the context, as we mentioned during the early parts of this session, that housing prices were rising at the fastest pace since the late 1980s. We know in the context of history that it's really rare for a housing market to be able to sustain a rate of growth at that higher level. Just as an example, last month, so at the end of March, we were seeing Sydney housing values rising at 3.7% month on month in March. I mean, an absolute rocket level of capital gains. Our daily index up to getting into sort of late April is showing that Sydney's already slowed down to about 2.3% month-on-month growth. So it does look like that trend looks to be evident across each of the major capitals as well. Again, historically, there's normally some sort of a catalyst to slow housing markets down. It'd be typically something like rising interest rates, or an economic shock like the GFC, or an economic slowdown like a recession, or it might be credit tightening. Any of those sort of examples of what we've seen in the past that would generally impact on a slow down housing markets. We haven't seen anything like that yet. So it's hard to know what the catalyst is to slow housing markets down, apart from just that organic factor of worsening affordability, or, of course, we're seeing stimulus being removed from the market. So first home buyers don't have as much incentive to buy into the marketplace. But we're definitely not seeing interest rates going to be going anywhere soon. The economy's got plenty of momentum and is continuing to outpace forecasts. It doesn't look like we're going to a recession anytime soon. We've already done that. The economy's momentarily in recovery mode. So I think these early signs are probably more about just affordability starting to slow the marketplace organically, and maybe the gradual effect of less stimulus in the marketplace, as well as we move into a period where the economy is going to be standing on its own 2 legs without all that fiscal support we've seen in the past.
Tim, if we go through your paper, number 1, you said CoreLogic's home value index is already indicating a slowdown in the pace of capital gain, which you just sort of highlighted there. Can you remind our community what your benchmark hedonic value home value index is and how it's measured, so that they can get context around this first point you raised?
Yeah, so if you look at some different ways to measure housing markets, you've got a really simplistic measure at one end of the spectrum, which might be something like a median price. A median is just simply the middle sales observation for any properties that transacted over a given period in a given region. And then you can go through the spectrum of sophistication up to, say, a stratified median, then a repeat sales index, and then getting up to the really sophisticated methods like a hedonic regression methodology, which is a valuation-based method It's more of a portfolio measurement. So we're estimating the value of every single property across the entire property portfolio. And portfolio, by that I simply mean every dwelling within, say, Sydney, or every dwelling in Australia. We estimate the value, and we remove any properties where we've seen a change in their attributes, which may signal a capital injection in the markets. We're trying to remove any sort of evidence of a capital injection or a change in the property. So the portfolios staying, remaining consistent, but also making sure we're not counting capital injections as opposed to capital growth. And then from period to period, we're simply measuring the delta change between the overall value of those underlying property valuations. So it's probably one of the reasons why we see our hedonic index being utilized so much is, it is very sophisticated, very complex mathematics behind it, but also it's very timely. We're publishing this index pretty much one day in arrears, and it is pretty much, it avoids any sort of compositional bias that might be in the marketplace. Like, first home buyers, when they're really active, can actually drag other measures down because they're median price measures. So compositional bias could skew price measures down. Because we're measuring the entire market, we don't have that compositional bias. It's very timely. We're getting about 80% of our property data prior to the government providing it to us as well. So thanks to our involvement with the industry. So for that reason, we can see a very timely measure of property values, which we actually update that index daily, essentially running the same methodology day to day. So you can look at the intra-month movements as well as the end-of-month movements, which I think are equally as important, and start to see any sort of inflection points in the market, which is exactly what we're starting to see now. It's just this subtle slowing in the pace of capital gains, which started to become evident towards late March.
It's hard to see on a podcast, but we're looking at a graph, and you can see Sydney, Brisbane, Melbourne, and Perth have all got a downward trajectory of your index to back up what you're saying. But Adelaide sort of is still trending up.
Yeah. Just to be clear, it's not a downward trajectory in values. It's a slowdown in the rate of growth. So we're still seeing really strong readings in the market, just not as fast a pace of growth as what we're seeing towards late March. So things just seem to be cooling down. But, in the context of averages, this is still a really hot market. We're still seeing, for example, Sydney housing values are rising at more than 2% month on month, which is well above average. A lot of people like to annualize these numbers. Annualize a 2.3% growth rate, you're getting well above 20% growth in a year. I think things will probably slow down further from here because arguably, or I think everybody would agree, we just can't, the housing market can't sustain a rate of growth that's that exuberant.
So we're seeing these, first movers getting in and willing to pay whatever they want to pay, but obviously that's that affordability story coming in as well. So I think that's a really good summation, that you can't just say 3.5% in Sydney, so all of a sudden it's going to grow at over 40% per annum over a year, and the same at 2.3% or 2%, that's 24% over a 12-month period, whatever that looks like. None of those things are necessarily a given. And from where Bryce and I sit, we want a sustainable, steady growing market. It's hard work, right, in terms of for anyone who's out there trying to buy or sell at the moment, because certain expectations are lifted from the vendor side where they think they're going to get an absolute knockout result. And then they're going to take a while to come off those expectations if things are slowing a little bit. And certainly from the FOMO side, on the buying side, that they won't just pay whatever it takes to get into the market. We want a sustainable market where there's more rational behavior rather than irrational behavior.
Yeah, absolutely. And I think anybody who's been active in the market the last few months would say that it's definitely been skewed to the seller. This has definitely been a seller's market. There's been an absolute surge in the amount of buyer activity, and the number of listings that are available have been generally quite low, which means people talk about FOMO. All that means is a lot of urgency in consumer decision making, and people feel like they need to rush into the decision, which is generally going to be one of the biggest decisions of anybody's life. You're spending hundreds of thousands of dollars at least. You've got to make that decision really quickly, and generally you're going to have to extend your budget maybe more than what some people would like to do. So yeah, I think if I'm right, and the housing market is just starting to slow down in its pace of growth a little bit, I think that's certainly a healthy outcome.
Yeah, so you've got obviously that indicator under your own roof there that you get insights in, but you're now, for the second point, you're looking outside and you're looking at clearance rates. So can you talk to us about that?
So auction clearance rates peaked around the middle to late March at about 83% across the combined capitals. And as we started working through April, it was clear that clearance rates were just starting to move through a curve, coming down generally up around the sort of mid to high 70% range. Again, averaging this out on a weighted basis across the capital cities, we're still generally seeing Sydney up around the low 80% to the high 70% range. Canberra, just last weekend, Canberra's clearance rate on the preliminary numbers was about 97%. So Canberra not really slowing down all that much, but Melbourne is now drifting down into sort of the mid 70% range as well. All these clearance rates are still quite strong. I think they're still very indicative of prices continuing to rise. We know historically there's been a very strong correlation between auction clearance rates and housing market activity and the pace of capital gains. But if this trend persists, then I think it's pretty clear that it's another sign that the pace of capital gains is slowing as we see auction clearance rates coming down a little bit. It's probably fair to say that since Easter, auction numbers are also coming down a little bit, which is seasonal. So typically Easter marks a bit of a turning point in auction markets, moving into the cooler months. They don't start to pick up again until sort of the middle of August and then really start ramping up in September. So there's going to be a little bit of seasonality creeping in here as auction markets cool down a little bit with the seasons. But I think we've seen evidence for 4 weeks now where clearance rates are cooling enough to call this a trend.
Yeah, I think when you take into school holidays and Easter moving around, etc., that's probably true as well. When we're probably seeing a little bit of that balance, but it's not quite balanced yet, but certainly a slowing of number of bidders and those types of things showing up. And Bryce and I were talking about it last week on the podcast where we were saying that just got a sense that some people are probably giving up a little bit or thinking, or their lives are turning, the economy's opening up, and that idea of having their own place versus renting still may not necessarily be a thing for them. So maybe we're going back to, that normality. It's early to call, but it's certainly showing up in that early sign data. So I think that's a ripper. In terms of point number 3, a rise in vendor activity.
Yeah, so we mentioned a bit earlier that listing numbers have been holding really low, and this has been one of the factors adding to this urgency in the market and the upwards pressure on housing prices. And listing numbers are still really low. Total listing numbers are still tracking well below average, but we're now starting to see vendor confidence lifting enough that we're starting to see new listing numbers. So fresh stock being added to the market is now tracking around 17% above the decade average. Above the 5-year average, well above levels from a year ago, which of course is when we're moving into a lockdown. So the year-on-year comparisons for listing numbers are becoming much less relevant. But as we see new listing numbers rising, we're still seeing total listing numbers holding quite low. But there is a chance that buyer activity is probably just starting to wind down a little bit. If I'm right about that, then we'll probably start to see total listing numbers or the rate of absorption just slowing down enough that total listing numbers just start to lift off their super low levels. And that will help to just even up the balance between sellers and buyers, add a little bit more leverage to a buyer's ability to negotiate, maybe a little bit more time in their purchasing decision as well, which again, I think is a very healthy outcome because things have been way too far skewed towards the seller rather than the buyer.
Yeah, it'll be interesting to see how the seller copes with that because they'll be buying they'll be making decisions based on a very strong market, and then when they get in there, there might be the extra stock and maybe some fatigue from some buyers mean they might not be getting the types of results that they're hoping for. But again, on the back of a bit of balance in the marketplace, it's probably not a bad thing. So that was number 3, rise in vendor activity. Number 4, sign that you published last week was there's a lift in new housing supply.
Yeah, so there's 2 different ways to measure supply. One is what we just talked about and how much advertised inventory is out there. The other way of measuring supply is how many new homes are being built. We know that the home builder grant has been hugely successful. It's resulted in an absolute surge in house approvals, not for unit approvals. Units seem to not really generally suit the eligibility criteria for home builder. But house approvals are now at record highs, and the December quarter commencements data really started to show that a lot of these approvals are now converting to starts, which of course for a house has a much shorter time frame to end up in a completion. Typically a big unit project could be, year and a half to even 2.5 years or so between commencing and completing. Houses generally have a much shorter turnaround time for obvious reasons. So we are expecting there's going to be this ongoing push towards more new supply coming into the marketplace at a time when population growth has turned negative as well. So the supply side really rising very quickly for newly built supply. The demand side derived from overseas migration, at least, still quite low. So again, I think this is a very positive outcome. We know that the residential construction sector is very important for the economy. We've always argued there needs to be more new supply being built in the market, and it's great to see more of that low density supply coming in, whereas previous upswings in the housing residential or the residential construction sector have been dominated by high-rise types of development. So quite a change of the guard now, where we're seeing more lower density styles of development, and high density styles of development still remain very low due to very low demand for that type of stock, particularly the fact that rental markets are quite weak in those inner city apartment precincts as well.
Tim, I want to talk to this story a little bit more. We might go off on a bit of a branch here, but I was looking at the unit oversupply. So the overhang, which is 46,000 odd units under construction in New South Wales up until December quarter last year, and 43,000 for Victoria. Now, we know that from anecdotal and sort of talking to depreciation companies and so forth back when we were debating the whole negative gearing around new versus old and who does that. So we know about 40 to 45% of investors are buying into that type of stock. Is this a reason why the level of new lending for investors is low? It's certainly part of my thinking around, traditionally some investors have been, through their financial planner or their accountant or their spruiker, basically telling them to go and buy, you're paying too much tax, go and buy an off-the-plan apartment. That is not happening at the moment because obviously you've got no demand supply for rent. So rents have been falling. So is that a lag product or a situation where that's the reason why we haven't seen, that investor data in lending shoot back up to the same levels?
I think it's one of the reasons, probably one of the more important reasons, and every single reason you said there, I think is correct. Investors are probably avoiding those inner city high-rise rental markets, partly because of the very weak rental conditions, partly because there's a supply overhang. Also, there's a bit of a legacy of construction quality, remediation costs with flammable cladding. So I think that inner city high-rise or high-density sector is going to be on the nose a little bit for investors for some time because of all those reasons. We don't expect rental markets in those areas to really bounce back until international borders open up. And even then, it's still a bit of a wild card as to how many foreign students come back into those precincts, particularly considering the tensions with China. So I think we will see investors looking towards different sectors of the marketplace. We know the medium sort of density sector like townhomes hasn't seen anywhere near the same sort of issues around a supply overhang, generally stronger rental conditions as well, but also moving into the detached housing sector. Rental yields are still pretty strong for investors. Outside of Sydney and Melbourne, they're generally around the mid sort of 4% range, if not higher. You can net those yields out to be something probably around the mid to high threes. Most of them are going to be in a positive cash flow scenario from the outset for a lot of those investors. So I think we will start to see investors picking up, but probably not in those inner city apartment precincts just yet.
So can we stay on this branch for a little bit more? Because I want to circle back now to the macro prudential. So assuming that we do potentially not see that uplift from an investor-led pressure in terms of, the banking sector and what has to happen around stability of the banking sector and that working group that looks at this type of thing, if that doesn't show up from the investor's point of view, what do you think their read's going to be if it's showing up from first home buyers or owner occupiers? I mean, there's got to be some political elements of that as well, right? Because ultimately, we all want the great Australian dream, and we want to see more Australians get their property. So I'm curious in your thoughts in terms of if that doesn't show up in the data for investors because there's not as many investors in the market, will they need to move on the macro prudential?
Yeah, I think underlying, regardless of the different buyer types, will be very close watchfulness on household debt levels. And regardless if it's investment or owner-occupied types of debt, any sort of rise in household debt could contribute to what they would describe as financial instability. Household debt levels have actually come down a little bit, so that's a healthy outcome. Again, the data is only up to December. My guess is it's probably started to bounce a little bit higher already. Household debt is very manageable at the moment, but I think the regulators and the policymakers will be acknowledging that when interest rates do eventually rise, the last thing they want is a heavily indebted household sector, which simply means households will be dedicating more to servicing their debt when interest rates rather than spending, which we know is really important for the economy. So yeah, in the past, these macro-prudential measures have definitely been more about reducing speculation, reducing investment in the marketplace, or keeping investors to a minimum. Whereas I think the next round of credit tightening will probably not really have much to do about speculation or investment levels. It'll be more about keeping those types of loans that could be contributing to higher household debt levels, the DDI, the debt to income levels, loan to income levels, and how much deposit you have will probably be the key ones they'll be watchful for, which kind of precludes investment anyway. So to your point, investors probably will pick up a little bit. I don't think any sort of pickup in investment from the very low levels at the moment are going to have much impact on credit policy. It's probably going to be more about household debt.
It's kind of taking the parenting role a little bit, just looking around the corner, isn't it? Because if people have got debt so cheap, they're making decisions that really are short-term decisions. So it sounds like, from what you're saying, they're just going to take that. We've been here, we know what's over the horizon, and make sure that people don't go too far. Look, the interest rates don't look like they're going up anytime soon, but they've still got to make sure that people aren't hocking themselves to the eyeballs, right?
Yeah, that's right. I think anybody getting a loan generally, I think by policy, they'll need to be getting the serviceability assessment on an interest rate that's more like around 5% or so 2 to 2.5% above the going rate. So there is some inbuilt buffer there in terms of serviceability assessments, which helps to protect the whole financial side of things. So for anybody who's really overextending themselves, I think they'll be in the minority, that's for sure. But definitely something the regulators will be watching quite carefully.
Well said.
The next one of your signs is around population growth or negative population growth, with difficult to move around the country with border closures and also, the planes not landing. So super interested to see what your feedback is on our population status.
So population into Australia, or overall population growth in Australia, turned negative through the September quarter for the first time since 1916. Really highlighting how important overseas migration is to overall population growth. So there's been a lot of questions since COVID became a thing and international borders closed about, well, how come population growth has pretty much stalled, but housing markets are surging forward? So it's pretty important to remind all your listeners that 70% of Australia's population growth are temporary migrants. So there are people like visitors or students that don't have permanent residence here in Australia, and that 30% that are permanent would generally rent first and then progressively buy as they figure out where they want to live and how much they can spend and where they have a job, that type of thing. So the longer closed borders remain, progressively, the more that's going to be impactful on actual buying demand. It's probably another explanation as to why we've seen such an immediate impact on those inner city apartment markets, which have generally been the main sort of overseas migrants have been one of the main tenancy sources for a lot of those inner city apartment precincts. So how long is this going to persist? Well, I guess that's a question for the federal government. When will we open up international borders and start to allow foreign students back in? That's going to be the main game here, not just to shore up our universities, which There's a lot of discussion around whether or not our universities should be as reliant as what they are on foreign students. That's a topic for someone else. But absolutely, if we do start to see foreign students coming back, that should help to shore up our tenancies in those inner city apartment precincts, and also reestablish that trend of those permanent migrants who'll be looking to actually purchase or build a home in Australia. But that seems to be some way off at the moment.
That was probably the big surprise for me in terms of my read last year when I was staying calm, is that I did think that migration would play some role by this year, and it hasn't. And still to see the demand in the market has been a bit surprising for me in terms of what that's. So, because you can imagine if we did have the immigration open and the level of local demand as well, then we would be still doing those 3 to 4% per month ranges, and that would be totally unsustainable. So I think it's probably a blessing in disguise that we haven't seen that immigration arrive yet. But I think you'll also, it would be high on the Treasury's, the RBA, and the government's position around getting the economy moving through wages growth. You do need that arrival. They are not job takers. All the research absolutely points to all of those arrivals creating new jobs. And given that we are hearing of, record job vacancy advertisements coming through in some of the reports, and a shortage of labour, that is a positive sign towards the instruments that the RBA are looking towards in terms of wages growth, and then ultimately inflation in the economy to get back to more normalised settings when it comes to monetary policy. So, I'm looking forward to when we do open up. And get back to even more normality in terms of that future population story, which is what Bryce and I have been talking about in terms of, the roaring 20s. If we are able to open up and the vaccine programs start to allow for that to happen, the decade looks pretty exciting for the remainder of the 20s. So that's a good news story. Number 6 out of the 7 signs of the housing market is moving through the peak of its growth phase is less incentives. Let's talk about that, Tim.
Yeah, so what we're referring to there is just simply less fiscal support for starters. So we all know, we've read about the fiscal cliffs that Australia's been through. The first one was moving through September last year, where we saw about 24 billion taken out of the economy as JobKeeper wound down, as JobSeeker was slimmed a little bit. Some of the other measures expired. And then at the end of March, of course, we saw JobKeeper expire completely. We saw Home Builder phased out as well. So another 5 and a bit billion taken out of the economy there as well, which in many ways is just a really positive sign that the economy has improved enough for some of these supports to be removed. In addition to that, then there's also other state-based incentives. You can look at WA, for example, having boosts to home builder, Victoria having stamp duty concessions, which expire around June as well. So there's a lot of things that are being taken out of the marketplace, which I think initially probably had a role of bringing forward demand to some extent. And we know from previous periods where there's been a lot of stimulus available, that bring forward of demand generally has a downside to it, which is the sort of vacuum effect is more stimulus is removed and then demand starts to taper. Probably the best example of that is back in 2009 when the boost to the first home buyers grant was removed, and first home buyer numbers, after absolutely surging to record levels, fell to levels that were lower than what they were pre-GFC. So that's probably something that's already is starting to play out. In fact, we saw the February housing finance data recorded about a 4% drop in first home buyer activity. I think part of that would be attributable to simply affordability constraints, blocking some people from getting access to the market, but maybe also the fact that there's less of this incentive and stimulus, which they can combine together to give them a leg up into the marketplace.
The important thing you talked about multiplier effect before. It's also interesting to put the context around why a lot of that is around the brand new stuff, isn't it, Tim? Because it as you say, there's the services that go whether you're established or you're brand new, which is all of the services revolving around sale and settlement of a property. But it's that stimulation that comes from having a Sparky and a Chippy and a landscaper and all those sorts of other jobs that come with building a brand new house that you just don't get in established. Because quite often we get a lot of questions from our community around why can't we get this on established? It's because there's a very big strategic reason why, and that's because of the amount of jobs that it creates, brand new versus established.
Absolutely right. And undeniably that the multiplier you get from building a new home as opposed to encouraging someone to buy an established home is significant. So you definitely don't need to be a rocket scientist to know why or explain why are the government stimulating or incentivizing building a new home. And I think the eligibility requirements, which really favored detached homes, were probably well placed as well, not just because of I guess the immediacy of building a detached home is there, but also there really does seem to be this preference shift away from higher density styles of dwellings towards lower density styles. Maybe that's just part of being part of a global pandemic, and people don't want to live in a high density environment and have a lot of shared amenity. But I think also when you couple that with more flexible working arrangements, which are becoming more common, and people being able to live in the outer fringes or in regional markets and not have to commute to work every day, then I think it's quite understandable we've seen this preference shift towards lower density styles of housing, which has really played out for the Home Builders Grant, which has been much more successful than I think even the federal government was expecting.
Mm. And rounding out your list at number 7 is high barriers to entry. And regarding deposit, can you talk us through? You've got a great graph here, which again is hard to translate on audio, but it's around saving that 20% deposit.
Yeah, so it's something we discussed a bit earlier on as well, that a lot of people see affordability as more a serviceability measure, being able to pay down debt. Whereas what we're talking about here is actually being able to get into the market in the first place. So as prices rise more quickly than household incomes, which they are absolutely doing at the moment, it means it takes longer to save for a deposit, particularly at a time when interest rates are so low. That doesn't really favor savers very well. So to put a bit of context into that, based on a household being able to save 15% of their gross annual income against the median value for each capital city, in Sydney, for example, towards the end of last year, it was already taking nearly 11 and a half years to save a 20% deposit, which I'm almost guaranteeing has increased between late last year and now. Nationally, it was a figure of 8.6 years. So it's definitely starting to see a lot more barriers for people to get into the marketplace simply because of the hurdle required to save, say, for a 10% or a 20% deposit. Of course, you still have things like lenders' mortgage insurance are available. You've got the 5% deposit guarantee from the federal government, which is capped. So there are a few ways around that, but for the vast majority of people looking to buy into the market, your deposit, as well as funding your transactional costs, which are also mostly percentage based off your buy-in price, are becoming much harder for people to actually achieve that first step of actually getting their foot in the door. Once you have your property, it's probably relatively straightforward to pay down the debt because interest rates are as low as what they are.
Yeah, that's an important distinguisher there. And just to quote your report, Sydney is 11.4 years, Melbourne is 9.8 years, Brisbane is 7.4, Adelaide is 8, Perth is 6.6, Hobart is 8.4, Darwin is 5.3, and ACT is 7.2. So clearly, everyone should be moving to Darwin if they're in that scenario, Tim, because it's going to take them 50% of the time will take them in Sydney to save the same 20%.
Yeah. Well, I'm not sure if Darwin's is everybody's cup of tea, but
that's the downside, right? 32 and cloudy every day.
That's the trade-off, right?
So clearly, there's a comprehensive list here. You did say the 7 signs the housing market is moving through a peak rate of growth. You didn't say the 7 signs that the housing market has stopped growing. So that's important. And you picked up on my little sentence stumble before around the graph interpreting Adelaide. But number 1 was CoreLogic's home value index is already indicating a slowdown in the pace of capital gain. That's number 1. Number 2 is you're seeing observing lower clearance rates. Number 3 is a rise in vendor activity. Number 4 is a lift in new housing supply. Number 5 is negative population growth. Number 6 is less incentives. And number 7 is the higher barriers to entry. But again, I think we should probably round it out that you are in no way saying that growth is actually falling. You're just saying peak growth.
That's right. We are expecting housing values will continue to rise throughout this year, just at a slower pace of growth. And even into 2022, it's I think we'll continue to see the housing market reasonably strong, but nowhere near as strong as what we've seen over the past 6 months, which was an inevitable outcome. That you just can't see housing prices rising that quick at a time when we know wages growth is going to be relatively low.
And Tim, you're talking about those in terms of, the first one you have in the paper talks about obviously the cash rate remaining lower for longer is going to be an important catalyst for that. You're also talking about a couple of other important messages there around consumer sentiment and also potentially migration or coming back in.
Yeah, that's right. So we've got low interest rates, and the RBA has been clear that they don't expect interest rates, or at least the cash rate, to rise until 2024. I think personally there's going to be a lot of economic data under the bridge between now and then. So maybe that might be a little bit optimistic, but I think absolutely throughout this year, throughout next year, we won't see interest rates rising, at least short-term interest rates. There's already some signs that longer-term fixed rates are already starting to push higher, 4 and 5 year fixed rates, which is understandable. Then on top of that, you've also got the fact that consumer sentiment we're expecting will remain quite strong. We know sentiment's really been buoyed by the strong economic recovery, by very low interest rates. And we know that there's a very strong correlation between consumer sentiment and housing market activity. So if I'm right in that, we should see buyer demand at least have a floor under it. And then finally, you've got that dual mechanism of labour markets probably remaining tight. I think we'll probably go through a bit of a blip over the coming months as JobKeeper exits, maybe see unemployment rise a little bit and jobs growth stall out. But it looks to me as if the jobs market has enough momentum to continue to tighten beyond that temporary pause as JobKeeper exits. And gradually, hopefully, as the vaccine rolls out and we establish more travel bubbles, we'll start to see international borders gradually opening. I don't know how that's going to look or when it's going to happen, but I think we've already started to see it happening with New Zealand, and my guess is we'll start to see more countries entering into agreements with Australia, but probably depending on how well our vaccination rollout goes and vaccination rollouts overseas.
And my final one for you is, you've been doing this for a long time. We always talk about the fact that Australia is made up of hundreds of sub-markets. We're not just one big market, but we've now just experienced a period where pretty much all of the markets are the rising tide is lifting all ships across most major markets. Can you remember the last time you observed that happening in this country?
Yeah, this is a really synchronized upswing. The last time we saw something that kind of resembled this was actually just after the GFC. So very similar in the sense there was a lot of stimulus on offer. We'd seen interest rates come down, nowhere near as low as now, but there was cash handouts. There was a first home buyers boost. There was lower interest rates, and we did see every regional market and every capital city rising at a pretty rapid rate of growth. Back then, we also had a pretty strong mining and commodities sector that's starting to flow through now as well. But you'd have to go back to 1988, 89 to see a similar rate of growth in the marketplace is what we're seeing now. So even though 2009 was quite similar, very synchronized, nowhere near as fast or rapid a pace of capital gains as what we're seeing at the moment.
And Tim, my final question was just around, we've talked about a lot of conversation around escape to the regions as we see, areas in snap lockdowns and extended lockdowns and so forth. Is there any data that you've been able to get your hands on as opposed to not just being first-time buyers buying in the regions, but basically city slickers also buying their second home as that backup for that new work-life balance that we've been told about?
One of the best data sets is the ABS internal migration data, which has recently been updated. It's only up to June of last year, unfortunately, so it only shows the beginnings of COVID, but it really clearly highlights the areas where this is most exemplified are in Sydney and Melbourne. So not just more people leaving Sydney and Melbourne to move to the regional areas of the states, but also more people in the regional markets of Victoria and New South Wales choosing not to move as well. So that's resulted in this, I guess, double whammy or double benefit for the regional areas where there's fewer people leaving, there's more people arriving, and that's really added to the level of demand in those markets where I think arguably the supply response is much more inelastic in those areas as well. We don't see as rapid a response to rising demand. And you can also look outside of Victoria, New South Wales. It's very much a story of interstate migration really starting to kick on now in Southeast Queensland. That was happening pre-COVID, but it's really seemed to accelerate. And we can also now see the first signs of interstate migration turning positive into WA and into South Australia, going negative in Victoria and New South Wales. Well, it's always negative in New South Wales. So we're really seeing quite a change in the demographic tailwinds or headwinds, depending on which place you're in, from interstate migration and internal migration, which when you then add that with overseas migration is making the demographic environment much different from what it was pre-COVID. Yeah, I think this will be sustained for some time, maybe not to the same extent as what we saw during the peak of COVID, where a lot more people were moving to the regional areas from the capital cities. I think as the capital cities become more vibrant and more employers are encouraging their staff to work in their offices or on site, maybe you'll see a little bit of momentum lost here. But that interstate migration trend into areas that are much more affordable than Sydney or Melbourne, say into Brisbane, into Perth or Adelaide, I think probably has some legs. And if you can work remotely, or if you can leverage the improving economic conditions in WA or South Australia or Queensland, then it makes sense that interstate migration trend will probably persist for some time.
There you have it. The man with all of the data at his fingertips, pulling all the levers to get all the great insights. So I love chatting with you, Tim. I could chat all afternoon. We could chat into tonight and into tomorrow with all of this stuff. So we greatly appreciate, obviously, all the great work and insights that you share with us, and also our good friends at CoreLogic. We will make sure that in the show notes we put a link to the paper that was released, so people can get access to that, and obviously check out all of the great CoreLogic suite of data. They are market leaders in their data, insights and research, and we greatly appreciate your time on the show and to share that knowledge with our community, Tim.
Thanks, Ben. It's great to be involved in your show as well. So thanks for inviting me on.
Yeah, thank you, Tim.
Thanks, Bryce.
There you go, Ben.
Tim
brings his A game every time.
Yeah, look, I mean, ultimately, he's one of Australia's leading, if not the number one, data analyst in the property space. So we're very fortunate to have Tim on the show, and as we say, his content and the data that they have at CoreLogic is world class. So it obviously adds to the conversation and keeps us all informed. And what my takeaway from the insights was that there's still growth to be had here. It's probably going to be pretty solid growth, but it's not going to be, sort of nosebleed speed at which it's going to be growing. So that to me is helpful, and in terms of a sustainable market, it means that, it'll delay any macro-prudential potential interference in the marketplace, and the market will sort itself out. So I think from that point of view, it's a good news story to say, yep, we're still got a couple of years of some pretty solid growth to happen, but it's just not going to be at the speed of which it has been for the last 6 months.
What I find remarkable with Tim and similar brains that operate like his is their ability to retain data. We saw that with Bernard previously as well, where they just riff off these numbers and it's like it just sticks in their head. Because the reason that stuck out for me then is because we were going through quite a technical report, and I had it up on the screen here as we were doing the interview, and Tim was just riffing off these numbers that were to the point exactly as it was in the report. So just the memory recall and the way that they know their data is, I'm not surprised. He's an A grader, right? But just that recall under those conditions.
Well, Nerida will say the same, isn't she? She's wonderful at being able to do all that work. Nerida Conisbee, if you haven't checked out any of the podcasts we've done with Nerida as well, that's also, she's a jet at putting all of that data, and like all three of them, telling the story around the data, putting the information together and giving it logic and insight. Data by itself can be pretty dry, but when you start to bring all of those pieces together, you just get a terrific insight, and sort of should give you some confidence in moving forward with your property plans over the course of the next 12 to 18 months.
Thank you, Tim. We appreciate you. The podcast community will appreciate your insights also. And let us know on socials. Stiggy will put a tile up there. Let us know what you thought about the insights and whether you agree. Do those 7 signs actually indicate that we have gone through our peak rate of growth, or do you see it alternatively? We always love to hear from everyone as to what your thoughts are as well. But my life hack today, Ben, is what I've done. You can see it, the listener can't, but it's actually a summary of the book. So I've gone and put the chapter, and then I've gone and put the takeaway at the end, and you think, oh yeah, big deal, it's a piece of paper. What I've done is I've actually blue tacked it onto the shower, Ben. So whilst I'm sitting there washing myself, I'm not going to be sitting there, I can be looking at this information, and so that it can be reinforced. Now, I did think about whether or not I'd put a link to this as a takeaway, but then I'd really get myself in trouble with the publisher if I did that. So for the real students of life, I'm going to encourage you to do exactly that. Buy the book, put the title of the chapter, then put the takeaway after it, and put it in a place that you can recall, whether that is on your phone, whether it's on your desktop, whether it's on your shower, wherever it is where you need to get this stuff to sink in, because if you can get that to sink in, it will make a remarkable difference to your life. Ben, what is making property news?
Well, Bryce, a few things that are making property news. So I put them into the theme of death and taxes, because obviously we're coming into the budget season, federal budget season, and we're not anticipating that that the Liberals will put any surprise changes to taxation for property investors. We think that negative gearing and capital gains tax levels will remain the same, but we're also seeing some information, obviously, around stamp duty changes in New South Wales. And in fact, this time next week, I will be sitting in a meeting with the Treasury Department of New South Wales Government to talk about their tax reforms with my picker hat on. So thank you for them to allowing us to come to the table and talk about the things we like about the tax reform and the things we're concerned about when it comes to stamp duty reform. So
that's important there, Ben, that everything that you want PIPRA to represent finally gets a voice. So well done to everyone who's joined the membership.
Correct. And it's an important, obviously we if you're part of the membership, we ask you to put a submission into the New South Wales government, obviously, which enough people did. So we obviously got on the radar. And so we're delighted to be able to have a few of our board representatives heading into a think tank room to talk more about that, to get some clarity on a few points. And so we'll look forward to updating, obviously, everyone in the community here, but also all of our picker members in regards to that. But yeah, so Bryce, I make predictions about politics. I'm pretty, every now and then I make a particular prediction and it comes true.
You're the first to pick Scott Morrison, yes?
Yes, when Scott Morrison was Treasurer, I said he'd be the next Prime Minister of Australia, and we got that one right. Well, I'm making a prediction now about what's going to happen with the Australian Labor Party. I don't know who the leader will be, so I'm not necessarily going to say that Albo will be the leader, but I can almost tell you that closer to the election, if housing affordability is becoming an issue, that they'll go after negative gearing and capital gains tax in some way, shape or form. I'm hoping they won't be silly enough, third time lucky on the same policy, but I just know they won't leave it alone. It's just going to be low hanging fruit for them to talk to their swinging voter and maybe the Green voter to get them to switch over to the Labor team. So that's my prediction, that if housing affordability becomes an issue, you're going to see the Labor Party introduce a policy. Again, they won't signal it early. They'll leave it right to the last minute, so you won't get much time to debate it. But that's almost a certainty. So I'm happy to predict that. But that's what they've realised.
The errors of their ways of giving a long run up on the negative gearing debate, then leaves you.
Yeah, maybe. But look, I mean, there's no doubt, like in anything in life, death and taxes are a thing. Some politicians and political parties like to mix them both together in death, taxes and alike. But we would like our politicians to spend less of the taxes so they don't take as much of our money off us. But that's normally not the case on both sides of politics and all areas of politics. But in this particular case, we know that death and taxes are what budgets are all about. So let's see what they provide to us in the upcoming May budget, and we'll comment about that in sort of shortly thereafter.
Okay, very good, nice. What's making property news? I really enjoyed the opportunity to catch up with Tim today. It's been a little while since we've done that. So again, folks, let us know what you thought. Thank you again to Tim for joining us, mate. But until next week.
Knowledge is empowering, Bryce, but only if you act on it.
All set. See you next week, folks.
Hey there folks, Bryce Holdaway here. Before you go, if you're new to our community and only listened to maybe a handful of episodes, I thoroughly recommend that you go all the way back to episode number 1, where we unpack all of the foundations when it comes to property investing. Now, for those of you that might be a little bit time poor, I've got good news for you. We have a binge guide that you can download straight away, which summarizes the first 20 episodes where Ben and I unpack the foundational pillars of the A, B, C, D, and so much more. And you can get that straight away. If you go to thepropertycouch.com.au/TPC20, you can download it and consume it whenever you want. It's completely free and available now. And for those of you, just a quick reminder that nothing we've spoken about today constitutes financial advice. We recommend that you reach out to your licensed professional advisor so that you can look at your unique circumstances before acting on any information. Now don't forget, go to thepropertycouch.com.au/TPC20 and get your binge guide today.